Hi, I'm Stephanie Shaw. This is for Advanced Accounting. The case analysis that I had to do was the analysis and research case, accounting information and salary negotiations. It is on Chapter 5, page 246. Granger Eagles Players Association and Mr. Doublecount, the CEO of Granger Eagles Baseball Company, asked for help in resolving a salary dispute. Mr. Doublecount argues that the Granger Eagles really lose money and, until things turn around, a salary increase is out of the question. As a result of your inquiry, you discover that Granger Eagles Baseball Company owns 91% of the voting stock in Eagles Stadium. This venue is specifically designed for baseball and is where the Eagles play their entire home game schedule. However, Mr. Doublecount does not wish to consider the profits of Eagle Stadium in the negotiation of the players. He claims that the stadium is really a separate business entity that was purchased separately from the team and therefore does not concern the players. The Eagle Stadium income statement appears as follows. The questions that they are looking for are: what advice would you provide the negotiating parties regarding the issue of considering the Eagle Stadium income statement in their discussions? What authoritative literature would you cite in supporting in your advice? What other pertinent information would you need to provide a specific recommendation regarding players' salaries? With the income statement provided by Granger Eagles Company Baseball shows a net loss of $60,000. From the ticket sales of $2 million, $1,400,000 of the baseball team's expenses are stadium rent. This is a large amount of the stadium's income. Salaries to the players only amount to $400,000. As you can see on the Eagles Stadium income statement, they show a net income of $1,820,000. Depreciation only accounts for $80,000 of their income. Since Granger Eagles Baseball owns 91% stock in the Eagles Stadium, the amount of stadium rent seems to be very high. Because of the Granger Eagles, the stadium remains busy and is able to show an income as opposed to a loss. If it wasn't for the rent that the stadium receives from the Granger Eagles, their income would be reduced dramatically. What advice would you provide the negotiating parties regarding the issue of considering the Eagles Stadium income statement in their discussions? I believe that there should be some negotiation in rent for the stadium in exchange for an increase in salaries. The Eagles Stadium is clearly making a majority of its revenue from the team itself. If it was not for the team, the stadium would not be there. This transaction would be considered an intra-entity transaction of depreciable assets and would have to be looked into further than just the income statements to make definite decisions. I would advise that Mr. Doublecount keep a close eye on how the company could change things to increase their income, but also make the players feel as though they are appreciated and wanted in the stadium. What other pertinent information would you need to provide a specific recommendation regarding the players' salaries? There's a lot more that needs to be provided than what is given to us in this. Everything needs to be closely examined when considering combining these two entities for income. A combined net income of $1 million is considerably large. The purchase price of the Eagle Stadium needs to be considered, a percentage of use compared to other events, a detailed list of player salaries, and the retained earnings balance for the Eagle Stadium needs to be considered. I do not believe that after looking at the income statements a definite decision could be made off of these, but looking into them further, they would be able to determine, and I believe that the salaries should be able to be increased because of the stadium's income.